No, but I think it might have something more specific to do with the yuan sell-off, the currency sell-off yesterday, which sort of punctured a rather large balloon of optimism that has swept over the country. And people, as you said earlier, are just trying to get out before the liquidity dries up ahead of the holidays.
This is not a free-floating currency. One assumes that if you do get that weakness in the yuan as it's marked to the US dollar, this is happening with the support of the PBOC. Would that be a fair assessment?
I would say that what we're watching for, as in earlier sell-off episodes, is whether there's any sign of the so-called national team stepping into the stock market. I think they might be a little early for them to step in because it's a 5% move today, but it's only one day. I think the larger story is kind of a return of volatility, and as I said, mainly about optimism. I mean, the yuan had gained almost 3.5% just in 1 month against the US dollar, and that seems a bit excessive by almost any yardstick.
Cliff, when it comes to the stock market, what stands out to me is that it looks like a fairly broad-based sell-off in some of the blue chips, not necessarily the speculative areas of the market. For instance, the Shenzhen's doing a much better, or having a much better performance than what you're seeing on the Shanghai Composite. What do you make of that and the sort of stocks that people are selling in this window?
It's what's most liquid. So these big stocks that you're talking about and that you're seeing being sold off is just where the liquidity is. You know, if you need to move a certain amount of money off to the sidelines because you're worried, then that's where you'll be doing the selling if you had to sell.
What's your view on when money returns at this point, Cliff? Because when it comes to the Wall Street sell-off, investors are saying, well, we still want to be overweight equities. So you get the sense that there is some buying going on the sidelines, not momentum sort of buying, but buying by some active fund managers. Do you think that is happening in the Asia markets and China specifically at the moment?
No, I don't. Not yet. I think I think the lead market in this sell-off has been the U.S. Treasury market, because of the inflation concerns and so forth. As long as the 10-year Treasury yield continues to climb, I think it's going to present an obstacle for risky equities and other risk markets. However, coming up in the next couple of weeks, we're going to get more inflation readings that might help calm the market, as well as some earnings numbers, which is going to be backward-looking because it's old. But if they come in reasonably satisfactory, people might take that as also a bit of a calming factor.
And just on the fundamentals, Cliff, there have been a lot of hedge fund bears out there, Kyle Bass, Jim Chanos, and so on and so forth, who've taken a very negative view on the currency for some time here, expecting that the debt levels will finally catch up with this economy. Is this that moment?
I don't think quite yet. I mean, we're expecting, depending on what the government does, it's really kind of path dependent. But let's say they don't do anything. Then, by the end of this year, by the fourth quarter, I think some of these credit problems that we've seen before in China will come back. But I think the game plan is to do something about it. Now, the problem is that to do something about it, it means to slow down growth. So there's always this internal contradiction between growing fast enough and doing something about the risks. And I'm fond of saying that, all Chinese policymakers really only have one goal, which is growth.